How's it, guys? Today I'm going to show you guys how to spot and trade the ICT 2022 YouTube model. We are going to cover the draw on liquidity and the pattern recognition of the model itself. I'm going to divide the pattern into three legs, being 1, sell stop run, 2, market structure shift with displacement, and 3, retracement and expansion. Okay. Okay, guys. So the basic essential of the model is you first want to see a run on liquidity. You first want to see a run on liquidity. For example, if you are bullish, you want to see price running below an old low, meaning sell side liquidity is being taken. Sell stop are being taken out of the market. That's why I level number 1. So your number 1 step is you first have to see the market running below an old low and taking out sell side liquidity. The second step, level number 2 here, is that you want to see a market structure shift, right? Meaning you have to see a market displacing above an old or intermediary high. So this high here, you want to see the market displacing above this high, creating a higher high, right? With displacement, the displacement is significant because it tells us, or it signals to us, that smart money has entered the market and is pushing the market up, and order flow is now changing from bearish to bullish. Because when you see this here, you can say this is a break of structure in the market now is going down. We're going to find out this was a liquidity grab. That's why we were coming here to grab this sell side liquidity, and now because we displaced above this high, the market has now shifted order flow. So order flow is now bullish. More importantly, between this 1 and 2 step here, between the displacement low and the displacement high, you must first, that's where your fair value gap will form, right? A fair value gap is when it's forming, it tells us that price is inefficient, and when price is inefficient, the algorithm will want to come back and efficiently deliver price. That means if a bullish fair value gap here is formed, it means it's a BC. That means buy side was offered but sell side was not offered, right? So the market at some point has to retrace to this fair value gap and continue going up. So you want to see a fair value gap forming in between the displacement low, which is 1, and the displacement high, which is 2. And preferably the fair value gap must be within a discounted price. How do you check a discounted price? You simply take your Fibonacci and place it on the displacement low and on the displacement high. So this is a 50% equilibrium. So anything above this is a discount, this is a premium market, and anything below the 50% is a discounted market. So you can see this fair value gap is within a discounted market. That's where you buy, right? We remove this. After identifying this fair value gap that is in a discounted market, we simply wait for the market from here, from 2, to retrace and form number 3, and that's where you're gonna take your sell position. When you take your buy position, your position is going to be something like this, and you're gonna target, and you can target this high, or you can target an old high where liquidity resides, right? So it's gonna be something like this. Hide your stop loss below protected low. It's a protected low because the market is unlikely to come below this low, because we already have a market structure shifting order flow telling us now that we are bullish. Now we're expecting bullish price. So price shouldn't come below this low. So this is going to be your target. Stop loss, entry at the 50%. You can either use the open or the 50% of the fair value. I prefer the 50% because it gives a better risk to reward ratio, right? With a bearish order flow, it's a similar concept but just flip. So instead of looking for the sell side liquidity to be run, now you are looking for buy side liquidity to be run. So number 1 here is your buy side liquidity. Why are we looking for buy side liquidity? Because this is liquidity inducement. Now we expect the market to go up. So number 1 is your buy side liquidity run. Number 2 here is a market structure shift with a displacement. It's a market structure shift because we displaced below this old low here. Right? The displacement low, the displacement high, the displacement low. So what that means is between 1 and 2, between the displacement high and the displacement low, fair value gap must form in between, and preferably now, because we are looking to sell, we want to sell in a premium market. We want to sell when the market is expensive. So you wait for the market to retrace into the fair value gap that is in a premium, and you take your sell here. And again, you hide your stop loss above this protected high, and you target an old low, or you can target this low, old low, or target this low, or you can take partials here and move your stop loss just below your entry point, and keep on moving and taking partials like that. So it's easy like that. I hope that's easier for you to understand, guys. So in recap, what do we look for bullish order flow? One, we look for sell side liquidity run, right? We look to take the liquidity out of the market, and we take out sell stop. Two, we want to see a market structure shift with displacement. Three, we want to see fair value gap forming in between the leg of the market of the displacement low and the displacement high. Then we want to see the market retracing into a discounted price, and we take our buy. For bearish order flow, we want to see buy side liquidity being run. We want to see this liquidity being run. Then we have a displacement high and a displacement low, making our market structure shift because we displaced below this low. Now we wait with now we look for a fair value gap in a premium market, because now we are selling in a premium market. Then we wait for the market to retrace into the fair value gap, and that's where we trade our sells. And guys, one thing that I want to emphasize is this pattern here. This is a pattern. This is useless on its own. So what you must do is you must also find your draw on liquidity. After, you must first find your draw on liquidity, then look for the pattern. So you must know whether the market is going to go up or down. So on to our next slide is, when you have this, you have your old high here. It's a, let's say it's a 1 hour liquidity here, right? It's a 1 hour liquidity. Now you know that because this is a 1 hour liquidity, our sell side liquidity, you know that sell side liquidity has been taken. After taking out sell side liquidity, where is the market likely to go? The market is likely to attack this high here. So now we have our bias. Our bias is that the market is going to go up and attack this liquidity here. So now you can be confident to say we ran sell side liquidity. We saw a market structure shift here with a displacement. We saw a market structure shift here with a displacement, and we have a fair value gap forming in a discounted market after the market structure shift. So now we can wait for the market to come and retrace into the fair value gap, and we take our buy position here at the 50%, sorry, 50%, and you can safely target this 1 hour liquidity, and you hide your stop loss below this protected low. That's how you do it, guys, right? In a sell position, you do the same, just in an opposite. You identify a lower liquidity on a higher time frame. That's your draw on liquidity, and you wait for the market to take out liquidity in opposite direction before going lower. So when you see buy side liquidity being taken and the market structure shift to the downside, now you are confident that the market is going to sell, right? So now, guys, now that we understand the theory part of the 2022 YouTube model, let's go to the chart and look at a few market examples. Okay, guys, our example will be on USD, right? Now we are on the 15-minute time frame. So this is pre-selected, guys. So don't fight with me. This is pre-selected. I just don't want to make the video too long by going to the market and marking everything out. So what we have here is you have your buy side liquidity and you have your sell side liquidity. So what you do is you wait for your 8:30 candle in the morning. 8:30 candle in the morning. So similar to what we have here. What we have here, sorry. What we have here. What we have here. You're gonna have here. So you have your buy side liquidity and you have your buy side liquidity run here after 8:30 in the morning. You wait for 8:30 in the morning. Now you have your liquidity taken out of the market. So when you see this liquidity being taken out, you realize that okay, buy side liquidity has been taken. Now we are looking for the market to attack this sell side liquidity. So after this buy side liquidity has been taken on the 15 minutes time frame, so the 15 minutes time frame, that's where you get your liquidity points. So 15 minutes liquidity has been taken out of the market, and now we are looking for the sell side liquidity to be taken out of the market also. Now let's go to a lower time frame, either 5 minutes, 4 minutes, 3 minutes, 2 minutes, or 1 minute, whichever one you prefer, guys. Whichever one. I prefer the 1 minute myself, so I'm going to go to the 1 minute. Okay, guys, now we are on the 1 minute, and you can see this is the 15 minutes buy side liquidity, and it was run here. Now this is the 15 minutes sell side liquidity. This is where we target. This is what we target. We sell above this. This is a manipulation, right? This is a manipulation. Now we sell in a distribution phase to go down, right? So you can see, let's zoom in. After this buy side liquidity has been run, what do you look for? You look for a market structure shift in opposite direction, which is fractal on the 1 minute. It's fractal in that on the 1 minute you look for a high, then a market structure shift low. So we have a high here. This is our first high here, which is also conveniently went above this previous high here. Now the market created a low, right? Now we have a low here. We have a high, and we have a low. We have a low. Now the market failed to create a higher high here. Then when the market fails to create a high, then the market moved below this low here. We have a break of structure. So you can look for your entries here, but if you look at closely, you cannot see any entry below. You cannot say this is a displacement, because you can see the candle are moving in a more sluggish way, and the fair value gap is formed in a premium market. So this is premium. How is it premium? Because we have this high here and this low here. So this is in a premium, in a discounted market. You want to see a fair value gap forming in a premium market, so that you can sell comfortably. So what you do, you keep on searching. The market created a lower low here, then created this high. When it was creating this high, it broke this intermediary high here. It broke this intermediary high here, which is known as our liquidity grab. This was an inducement. This is our liquidity grab. So we have another buy side liquidity being taken. We have another buy side liquidity being taken. And after taking this buy side liquidity, you can see from this candle, we have 1, 2, 3, 4, 5, 6, 7, 8 down candle, consecutive down candle. That means this is our displacement. This is our displacement. This is a displacement that we've been looking for, right? We have our displacement, which displays below this low, making our market structure shift. This was our break in market structure. This is our market structure shift, right? So you take up your fib again, put it here. Now you are looking for your discount in premium. So which fair value gap are in a premium market? We have a fair value gap which is in extreme premium here, and we have another one which is partially in a premium. So you can see this one. This fair value gap is partially in a premium, because the lower part of the fair value gap is in a discounted market, and the upper part of the fair value gap is in a premium market. So I won't use this fair value gap. I'll prefer the market to come and tap into this fair value gap here. So what we have the market making a lower low again, then the market coming up and going above this fair value gap. So when we have this here, now we know that we can take our sell comfortably at the 50% of this fair value gap here. At the 50% of this fair value gap, where do you hide your stop loss? You hide your stop loss above this protected high. The protected high, because the market has already shifted lower, and the market has no reason to go above this high. So now you can target the 15 minutes sell side liquidity. Where is this 15 minute sell side liquidity? This is our 15 minute sell side liquidity here. And the market entered. Let's you can see it didn't take out your stop loss here. The market entered, Let's see how long it took. Get out of this position. It took the market going into the attacking the sell side liquidity the following day, because this is now the following day. But you take your sell here, you hide your stop loss above the protected high, and you target this 15-minute sell side liquidity, and that's where we did. The market started going down, down, and when it's going down, it respects PDRA to the downside, right? If you can see here, you have your breaker here, high, low, then retest here, and the market keeps on going down, right? So it's as easy as that, guys. If you have any question regarding this model, please do comment into the comment section and tell me where you didn't understand, so I can clarify even further, or where you want clarification or you didn't understand further, right? Till we meet again next week, guys. Peace out, and please subscribe.